We're here to talk about the Silicon Valley real estate marketplace ending the week of May 22nd, presented Saturday morning, May 23rd. These are the key chapters we're going over in approximate timeline. We're going to start off with about a 10-minute summary. This is a control panel. We'll get down to that on slide 7, I think it is. Here is the first data slide. This is showing the volume of transactions, and the solid line is the current year. The dotted line is the 10-year median. Notice that the solid line for the first 3 weeks is higher than the dotted line. That means we are accepting more offers this year than we have for the median of the past 10 years. That's a complete reversal. I think it was only 2 weeks ago we were looking at this data and we were below and separating further. Now we're above for the first 3 weeks. For 1 week, the blue line, you can see the dotted line is right about there. The solid line's here. The green line, the dotted line is right about there. The green line, the solid line's here. So you're selling slightly more. It's close enough, I'd call it even. But that's significant because we've been selling only 20% of the volume of transactions since the 2022 price correction. If we're now at 100%, that's huge. I'm surprised by it. I wasn't expecting this turn. In fact, I was expecting to see a drop off. The fact that it's coming up. Now, when you get to the 4-week data, it is still below because we're going back further in time. And the 5-week data, which is what the bulk of the presentation on, is also down, and you'll see that number. I think it was close to 90% up from 85 last week and up from like 81% the week before that and going the other direction 2 weeks ago. So that's a huge change. Here's a quick summary, a recap. We're currently taking 23% longer turnover time. That's how long it takes to sell the market one time. But it's only 39 days. That's only 6 weeks. To sell the property, the entire inventory in 6 weeks is pretty incredible. And the 23% longer is down from, I believe, 40% just last week. So we had a huge number of offers come in this week, which really reduced the turnover time. Marketing time is 42% longer than normal. So again, indicating a slower marketplace. But again, it's still only 3 weeks. Put your house on the market, and for 3 out of 4 sellers to sell in that 3-week period of time is pretty amazing. Price reductions are 2 times a larger magnitude than they normally are, but that's only a 1.1% price reduction. We have a shortage of 10% of the offers, so right there, I think it's actually 9.5%, and the number should be over here, right there. Yeah, 9.5%. So you jumped from 81% to 91%, a 10% gain in the offers, or the reduction in the missing offers in basically a 2-week period of time. You do have a surplus of inventory, but it's down to 13%. And despite most of that being pessimistic data, although it's more optimistic than it was, overbidding is basically right exactly where you'd expect it. It's 6.8% overbidding. The expected is a typo. It should be 6.8 expected. But again, that's close enough that I would call it equal. So you have the normal amount of overbidding. But the overbidding is lagging behind, and the overbidding has been coming down. But again, that's a lagging indicator because we need the sold price. Here now are the key indicators that we sort of recapped. You got 7 metrics coming down the left-hand side. The purple line is the current data. This current week is in the middle, so that's why the data doesn't go further over to the right. But that gives you an indication of the direction the market's likely to do. You were expecting a decrease in the turnover time based on the slow marketplace, but based on the typical marketplace, it's basically flat. So that's why you've had this improvement, is we're sort of a hybrid leaning towards a slow marketplace and picking up a little bit of that characteristic. So we did an improvement this week, and I would expect an improvement next week because buyers tend to stay on the marketplace during holiday weekends where sellers tend to not list. So I noticed a shortage of listings this week, which would also improve the turnover time. So this may just be a little bit of false alarm with the holiday. You had a surplus number of offers accepted, which is a positive thing because that's what's been missing. But it's corresponding with an expected reduction in the number of new listings coming on the marketplace. Therefore, your inventory reduced, therefore speeding up your turnover time. But you can see we're still at that 39 days that I talked about, and it's 23% longer than normal. And here's your range. The slowest you'd expect is 45 days. The typical would be basically 32 days, so you're a week longer than typical. And your quickest time frame is only 27 days. Marketing time is how long it takes 3 out of 4 sellers to sell. It is longer than expected. It's 42% longer than expected, but it's 21 days. So it's 42% longer and 3 weeks at 22 days. And again, what you're seeing here is the purple line is the raw data for this week. So you can see you're pretty close to the blue line. The blue line is the 90th percentile, the longest you'd expect based on the past 10 years. The gray line is where you'd expect the market to be. So you can see we're a whole week slower than you'd expect the market to be. And the red line is the fastest you'd expect the market to be. So the market is still slow for Silicon Valley, but it's based on the offers accepted, it appears to be improving. And based on any reasonable benchmark, the Silicon Valley real estate market is still good. Price reductions. You're typically at half of 1%. Right now, you're at a full percent price reduction. And that's why you're 2 times. You're 199% of the normal price reductions. And we'll see later in the presentation, this is more the magnitude of the sellers, the price reduction sellers are taking, plus combined with a slight increase in the frequency. So it's a little bit of both that's causing that to happen. Here's your overbidding. You can see you're right on top of the gray line, which is why you're at 6.9%, where you're typically at 6.8%. So slightly more overbidding. But again, this is lagging indicator. This is telling you where the market was 5 weeks ago. And because 2 weeks ago, the market was sort of the worst short-term recent past, I would expect the overbidding to go down for another couple of weeks before it reverses and starts reflecting the current optimistic trend that I'm noticing with the offers accepted. And let's talk about that offers accepted. We're basically at 2,500. You'd expect 2,750. You're still missing a full 10% of that offers. And that's why you're at 9.5% miss offers. But if you look back in time, 2023, we missed 25%. 2024, 2025, we missed 20%. So if we're only missing 9.5% now, that's pretty good. And part of the reason we're missing some is because the pandemic, it gave us a surplus, but now we also had a year of low sales too. So those sort of balance each other. Because remember, I'm using the median for the past 10 years, and I don't use the current year when I'm in control. And so this is the 10 years that I'm using for the benchmark are 2016 through 2025. Inventory. So here you can see the decrease in inventory, which is expected. Now, Memorial Day is a holiday that moves by about 7 days over the time frame. So that's why the median is sort of flat through this time frame. We went down going into the holiday. I would expect this inventory to come up after the holiday. Sellers basically don't want to have a holiday interfering with their first week on the marketplace, at least those sellers who care about maximum exposure the first week. And the last indicator at the very bottom of the table here is number of transactions. That's on there. It's sort of definitely a lagging indicator. It's number of transactions that actually successfully close. And it is what drives the industry for the most part. And you can see that it's actually missing 22% of those closings. Now we're looking at the 3 of the indicators over a long period of time. We're going back to January 1st of 2016 on the left-hand side. So you're looking at the 10 years that make up your median from 2016 through 2025 is the 10 years. And then the ratio is based on that 10 years to the current. We're starting off with the turnover time. You can see the huge improvement this last week. And, just a few weeks ago, we were at the peak and close to record high. Now you're coming down to almost reasonable territory. So yes, the market is taking longer than normal and it's still fast, but, it's still slow for Silicon Valley, if that makes any sense. I guess the surprise here is the magnitude of this improvement. Now, with the holiday impact, I would expect a reversal next week, and it will be interesting to see how much reversal we get. Offers accepted down here on the orange line, you can see the huge improvement in the number of offers. So this is offers accepted, and you can see that we jumped from 80%, 81% last week to 90.5%. So 9.5% roughly jump in the number of offers in 1 week. And I did notice that myself just when I was looking through the data. I'm like, wow, there's a lot of offers this week. So for whatever reason, this was the week that a lot of buyers popped up. And it's interesting too, because interest rates went up pretty high too. I think they're very close to 6.5%. I don't remember the exact number. They may actually be 6.51%. They jumped up quite a bit from the previous week. And that would be the national average for the high balance conforming loan limits. And then the third and final component is the active inventory, and you can see active inventory went down, and that's directly related to the holiday. The increase in the offers accepted is typically not related to the holiday. You would normally expect just a normal level of sales going into a holiday, but the decrease in the active inventory is expected, and that's not because people pull their house off the marketplace. It's because you just have less new listings coming in the marketplace to replenish what came on. And a lot of that didn't come on this week comes on next week. So we may see a resurgent, an increasing, which is a degradation of the marketplace as far as inventory, active inventory. Okay, this is the control panel. This is how you participate. So the first one is the handout. The handout is up for this week. So you can type in the blue long Google Drive. You can type in the green root URL plus the letter H for handout 2026 for the year, 05 for the month, 23 for today's date. And you'll get about a 77-page handout, or you can hit the QR code. To join and participate in the presentation Saturday morning live, you can hit the QR code or hit the Zoom link here in blue, or again, hit the green root URL plus just the year 2026. And that's a tiny URL that takes you to the Zoom link for less typing. And then for the archive, to go to the YouTube channel, you can hit the QR code on the lower left, hit the blue URL, or type in the green short tiny URL to get to the YouTube archive. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers here in Silicon Valley. Oh, before we continue, this is a little recap of different things I do. If you're concerned about schools, I can give you the names of the different schools that attend. I can give you the ratings of those schools. I can give you commute times. I can give you links to Google Maps. Anything that helps you as a consumer or buyer to better decide what properties you do and do not want to look at. Even orientation of the property is something that's easy to add on to the listing information. Let's continue with the presentation. Here are some definitions for the stuff that we're going over next. So this is the micro market data. This is what I think is key. Even county data, even Silicon Valley data, Bay Area data is irrelevant for what's going on in a different area. We will see over and over again the high priced areas, like you'll see right here, Los Altos, Palo Alto selling the fastest at 22 days. That has nothing to do with Gilroy at 64 days. That's 3 times difference. That's the whole purpose of micro market data. Is I spent a fair amount of time when I was back in the 90s working on my own account, trying to group similar acting markets together to understand what was happening in the different micro market areas, covering a fairly large area of Silicon Valley. Anyway, you can see the numbers range. Silicon Valley overall is at 39 days. Santa Clara County is at 40 days. San Mateo County is the fast one at 33 days. And the slow county is Alameda at 42 days. That's still only 6 weeks to turn over your marketplace one time. So you completely refresh the marketplace in 6 weeks if everything was uniform. Now, everything isn't uniform. Some homes sell in 1 week, some homes never sell. This is the turnover time compared to normal. The last one is simply what is the turnover time? That's how much pressure buyers in the feel out in the field. This is how we stack up to compared to normal. And you can see that Santa Clara County, in a nutshell, is cooler than normal. And you see that right up here on the number, 32% longer than typical. San Mateo County over here is multicolored because it's at 104%, and it ranges from a fast turnover time in Redwood City of 77 days to a long time in Foster City of 175 days. Now, Foster City is a very small area, and so is the San Mateo County coast as far as volume of transactions. So it really varies from basically 76 days to 124. Pacifica Daly City is starting to get to be a fairly large micro market area. So it's balanced and on both sides. Alameda County is green because it's still normal, but it's a little bit of a blue-green when you come over to the white background over here, and that's because it's at 12% longer than normal. And I don't have micro market data for Alameda County in all the areas. Marketing time, this is a more realistic market. Turnover time includes the sellers that don't sell. Marketing time only counts those successful sellers, and it's 3 out of 4 sellers. So it's basically ignoring the sellers that come on the marketplace. And it's a significant portion we're ignoring because about 50% of the listings come on the marketplace, sell the first weekend, and we're looking at the median of the remaining 50%. And so anyway, this is the time for 3 out of 4 sellers to sell pretty close together, ranging from 20 days in San Mateo County to 21 days in Santa Clara County to a long time frame of 24 days. So only a 4-day swing, a half a week swing in Alameda County. So you range from 20 to 24 days. Basically, everybody's right around 3 weeks, just under or slightly over 3 weeks. Now, what's marketing time to normal? Look how blue and how green it is. Again, Santa Clara County is blue, so it's taking along, and it's at 140. But the average, and partly because Pleasanton is up here at 3 times slower than it normally is, but the numbers work out that Alameda County is the slowest county at 150%. Look at some of these numbers in Alameda County, 300% in Pleasanton, down to only 25% slower than normal in Fremont. Berkeley and Alameda cruising along at 7% slower than normal. So a huge change just within the same county. And we'll see that on price later too. I hope I remember to share that. Here's the price reductions that sellers are making. And these are the average price reductions. So the number's very small because, as we'll see later, the vast majorities make very small changes. But again, Santa Clara County is getting beat up the most with 1.3% price reductions. San Mateo County is in second place at 0.9%. And taking the least amount of price reductions right now is Alameda County at only 0.8%. But again, you go from Berkeley, where they're actually taking, when the offers come in, or sellers are raising their own ask price 0.1% before they accept an offer, raising it to control the amount of activity, I would assume, to something like Pleasanton. Well, actually, Oakland is worse than Pleasanton at almost a 1.5% price reduction. Now, again, 1.5% may not sound like a lot of price reductions, but if 4 out of 5 sellers aren't reducing their price at all, that 1.5% becomes pretty significant. This is the reduction versus typical. So again, you can see Santa Clara County is getting hit pretty hard at 98%. And this is the ratio between the list price at the time the offer is accepted to the original list price. So there's a 2% reduction, 2% reduction in San Mateo County, but a 3% reduction in Alameda County. Frequency of price reduction. Remember that Santa Clara County have been doing the worst, but look at these reductions. You're talking in the worst areas, you're talking about 1 in 4 sellers are doing a price reduction. In Cupertino, Sunnyvale, it's only 6%. So that's 1 in 16 sellers is doing a price reduction, and we're in a slower marketplace. I mean, that gives you an idea of how uncommon price reductions really are. The range is Santa Clara County is taking the most at 17%, followed by San Mateo County at 13.7, closely by Alameda at 13.7. But again, you in Pleasanton, 1 out of 4. I mean, you change in Silicon Valley, you're changing from Cupertino with 1 in 16 sellers doing a reduction to Pleasanton, where it's 1 out of 4. 4 times more frequent price reductions in Pleasanton than in Cupertino, Sunnyvale. Frequency compared to typical, Santa Clara County again is doing the worst at 52% more price reductions than normal. This is the number of sellers that are doing price reductions. San Mateo County is doing the best at only a fifth more, and Alameda County is doing in the middle at 50% more. Santa Clara County and Alameda County are not that far apart. Alameda being slightly lower than 50% and Santa Clara being slightly higher than 50%. Overbidding, this is what the buyers are doing. So what kind of pressures are the buyer feeling? Look up here at the island of the Alameda and Berkeley. They're bright red. They're looking at 23 and 16% overbids in this marketplace. It's just amazing. And then you go to Pleasanton, where there's a 1% overbid, even though they have a huge even though they're taking 3 times longer than they normally do, buyers are still overpaying 1%. Why is that? It's the homes that are priced right. The buyers come in and it meets their needs. They're willing to pay more than the seller's ask price to try to assure that they get it. Or a long-term seller that took a price reduction, took too large of a price reduction, and now boom, in comes the offers, and the offers come in higher than expected. San Mateo County is next at 6.5%, and the least amount of overbidding is in Santa Clara County at 4%. And I don't know if I've noticed this before, but Gilroy is actually coming in at 0.5% below the seller's ask price at the time the offers are coming in the door. So their buyers are feeling no pressure and actually feeling like they can negotiate the price down by 0.5%. Here's compared to typical. Look how blue this chart is. I mean, all of Santa Clara County, for the most part, is blue. A good part of San Mateo County is blue. So that's less overbidding than normal. And then the rest is green, which is normal amount of overbidding. So what are we looking at? Silicon Valley is right at normal. Santa Clara County doing the worst with a 1.4% less overbidding than normal. San Mateo County next at 99%, so missing 1%. But now Alameda County, the county that's doing 3 times longer, at least Pleasanton, is actually getting 2% more. They're getting the higher overbid, larger amounts of overbidding than typical. Here is the frequency of the overbidding. So just how common is it? Basically right around 70%. Santa Clara County is Silicon Valley actually is right at 2/3. You can't get closer than 2/3, but you're right at 2/3. Santa Clara County only 60%. The county that's doing the most overbidding, the most frequent overbidding, is Alameda County at 71%. San Mateo County is in between at 68%. This is the frequency compared to typical. So again, there's no red, so we have less frequent overbidding than we typically do. Santa Clara County, again, in last place. I mean, go back a couple weeks ago, and Santa Clara County was doing best out of the three counties. Now we're cleaning up the last place. 14% less frequent overbidding than normal. And it ranges from Gilroy at 60%, Milpitas 70%, all the way up to Los Altos at almost 90%. Notice the high areas up here, the expensive areas up here in general are doing better, although the affordable areas, the most affordable area is doing as well as almost as well as the expensive areas. It's doing as well as Cupertino. San Mateo County at 93%, and that's the second worst, and doing the best with the frequency of overbidding is Alameda County at 96%. So it's 4% less than normal, but it's doing the best overbidding, even though it has some of the longest marketing times. Offers compared to normal. Look at these numbers. 3% more offers than normal in San Mateo County. Alameda County missing 20%. That's where the whole valley was, the Silicon Valley was a little bit. And Santa Clara County is at 95.5%. So Santa Clara is almost normal. It's 4.5% under. San Mateo County is 3.25% above. The only county that's really lagging behind right now is Alameda County. If we could get their sales volume up, we might even hit 100% of the normal volumes or offers accepted. Here's the active inventory. Again, blue and green in color. There's a little bit of pink in the expensive areas. Notice the only red is Saratoga, Los Gatos, Los Altos, Palo Alto, Atherton, Menlo Park. So they have less inventory. And, last week it was a little bit clearer, and it might just be simply the holidays. Holidays impact expensive areas more than affordable areas. It could be simply that the holidays are now impacting us. But remember last week I was pointing out how the high end of the marketplace was doing better than the median price. It was almost correlated, especially in Santa Clara County, to price versus performance. The higher the price, the better performing. This is sort of indicating that too. There's a lack of inventory in the expensive areas. The moderate and the affordable areas have a surplus. And look at the areas that have the highest surplus: Milpitas, Berryessa, Boston Valley, and Santa Teresa, plus surprisingly Cupertino, Sunnyvale. And I don't remember what the numbers were for last week on that data. There's just too much data, but that sticks out because it's a higher priced area, and the other higher priced areas have a shortage of inventory. They have a surplus of inventory in Cupertino, Sunnyvale. This is appreciation. This is going back to the last 9 months of 2015, where you had nice stable pricing. It shows you the areas that are doing the best. And again, let's look at Santa Clara County. You have 114% appreciation, so you've more than doubled your money. But then look at each one of the micro market areas. No area has done better than the affordable areas at 95% appreciation, and the expensive areas have done the least well. How do I possibly explain these numbers and the county number? It's market mix. We're selling the top end from last week, the top end of the market down here, the bottom three areas, we're doing the best. They raise the median because they're contributing more high-priced homes without impacting the value in any given area. This is a great example of why it's important to look at the micro market data versus countywide data. If you looked at Santa Clara County and said you're getting 114% appreciation, but then each given area, the highest area was 95%, that's a huge difference. It's a 20% swing in the performance based on what data you use. No difference in reality on the street, just what data you report has a 20% swing in what you're reporting. Here is pricing. The middle number is the median number, which most people follow. I added on the left-hand side the cheapest 10 percentile on the left-hand side, and the most expensive 10 percentile or the 90th percentile in the given area. So in any region, in any micro market area, you can quickly find out what the price range is. So the range of which you can expect to find homes. And the color is simply what the median price is. So Atherton is the most expensive, so it's going to be saturated red. And Hayward, San Leandro, and Oakland are basically tied for last place. So that's why they're saturated blue in color. Here's a summary. You basically look over on the left-hand side, and that's what the raw numbers are. So that says that Silicon Valley is doing fairly well overall, but then you compare it to the median of the past 10 years, and here you're basically balanced. And I need to research Foster City because that number doesn't make any sense. And then you look at the offers accepted, you can see which micro market areas, and it's Los Altos, Palo Alto has a full 25% basically more offers accepted than they typically do. And then active inventory, and the only areas that are really shortage again are the expensive areas, the appreciation rate that we talked about, and then the price. Here's some definitions going over to the metrics for Silicon Valley. This is, we're looking at the turnover time. So the turnover time is the purple line, concept's the same. The gray line is where you'd expect the data to be. The blue line's the highest, the slowest turnover time, and the red line favoring the seller is the fastest, the lowest turnover time you'd expect. When you're just under 40 days, you'd expect to be down here somewhere around 35. Here's percentage of normal. You can see that we're 22% or so of normal. You can see the huge improvement from last week. Here's looking at the marketing time. This is only taking the successful sellers, and you can see we're right at 22 days. We're below the longest time you'd expect, but we're significantly longer than the shortest time you'd expect, which is down here around 16 days. Percentage of normal, you're 42% or something like that, slower than normal, flat from last week. Here's the number I like. It looks at the sellers that are taking the largest price reductions. What kind of price reduction are they taking? 12%. If you look at this median price for Silicon Valley being somewhere around $1.8 million, a 12% hit on that is somewhere around $200 and some thousand. That's not insignificant. You know, it's approaching $250,000. Here is the more commonly reported number, the average price reductions. It's 1.1%. So when you see actually it's like 1.02%. It's pretty small. It's essentially 1%. So you go from 1%, but yet the sellers that are taking those big price reductions were taking 12% price reduction. So they're taking more than a 10-time fold increase over the average. Here's that average on a percentage basis. So we're taking more, but we've been improving for Silicon Valley for the last couple weeks. Here's the frequency of price reductions, less than 15%. So less than 1 out of every 7 sellers in the 3 counties takes a price reduction to get an offer in the door. Here's the frequency compared to normal. So that's 40%. Look at the climb. We've been basically climbing fairly significantly since the middle of first quarter, basically straight up. Yes, there was a little pause, but you know, if you're just drawing a straight line, that's a pretty steep climb. Here's overbidding. This is the only time we talked about median. So that's half the buyers offer more and half offer less, and 3.5% above the seller's ask price. This is back to average. You can see that we're right on the 100% line. That's why the purple line, and it looks like the gray line actually slipped up a little bit. Frequency of overbidding. How common is overbidding? I think the number was 66.6%. 2/3 of the sellers are getting more than their asking price, but that's less than expected. You'd expect to be up here. We're almost at 74%. So we're missing about 8 percentage points of the overbidding. Frequency is less than normal. It's about 92% of the normal level. And the amount of overbidding is decreasing. That doesn't tell you current market conditions. That tells you market conditions 5 weeks ago. Based on what I'm observing, I expect this to come down a couple more weeks and then very potentially turn around and climb back up with the increased level of activity if it continues after the holiday. Here's the number of offers accepted. You can see the significant increase just in the last couple of weeks. It's hard to see where last week was, but I would guess it's right about there. So you had what would that be? 100 increase of 100 additional offers being accepted in 1 week. Here's on an active inventory. You can see the inventory peaked last week and came back down. That's the holiday impact. We had less new listings come on the marketplace this week. Here's the appreciation based on the cheapest homes, the most affordable homes down here in the blue. They've done the least well. The median price has done the next best, and the most expensive homes have done the highest appreciation, almost 100 and about 108%. You have to subtract off the base from here. Here's 3 pricing models. You can see the median price has come up and been flat, but if you look at the high price, came up at basically the exact same slope, but then instead of being flat, there's a general increased tendency, And on the low end, the more affordable, there's a slight downward trend on pricing. Again, that sort of plays into the big talk right now about the K economy, where those that are doing well continue to do well. Those that are doing poorly are hurting more with the high price of food and the high price of gasoline. Here's the payments going through an 80% loan using the high balance, conforming high balance interest rate, which is right around 6.5%. You can do better by jumbo rate, and even better than that by having relationship pricing if you have a stock portfolio that you can transfer to the lender that you want to get your home mortgage through. Here's some definitions when you're comparing the three counties, which is what we're doing next. It's the same metrics basically. So this is turnover time. You can see that San Mateo County is doing the best. Santa Clara County right at 40 days is next, and then Alameda County doing the worst at 42 days. But again, that's 6 weeks. Time to sell, 3/4. San Mateo County is doing the best at 20 days. Santa Clara next at 21 days, and Alameda at the slowest at 24 days. Price reductions, Santa Clara County doing the worst, very unusual. San Mateo and Alameda County very close together up here at about 0.8, 0.9% price reductions, where Santa Clara County is approaching 1.5. It's 1.3%. It looks like price reduction. Frequency, Santa Clara County, the most frequent price reductions. Alameda and San Mateo County doing significantly less price reductions. Overbidding, Santa Clara County doing the least, San Mateo County next, and Alameda County doing the best on overbidding, and by far the best at over 10% overbid. Frequency of overbidding, San Mateo County is in the middle, Alameda County has the most overbidding, and Santa Clara County has the worst. Look how Santa Clara County has just been dropping off on the frequency of overbidding. Offers accepted, Santa Clara County has got the most, in part because it's one of the largest, but Alameda County is selling less offers than Santa Clara, and you can see they historically are very close together. San Mateo is smaller, lower number because it's a smaller county, less inventory. But notice that it's very clear in San Mateo County, they're selling more homes now than they have any time since the 2022 price correction. You know, regardless of the time of the year, they're at 500. You have to come all the way back here to midway through second quarter to have a higher volume, or even early second quarter. Active inventory down in all three counties, and that's because of the Memorial Day holidays. Moving on to appreciation, Santa Clara County has the highest appreciation. We already talked about the reason being the market mix, followed by San Mateo and Alameda County very close together at about 185% appreciation, and that's since the last 9 months of 2015. Median sold price, San Mateo County has the highest sold price at about $2,170,000. Santa Clara County is next at about $2,050,000, and most affordable county is Alameda County at about $1,375,000. Here's the same information on log paper. Log paper is nice because it's easier to see the rate of appreciation. You can see you had for San Mateo County, you had a very steep appreciation, then a less steep appreciation, and then basically flat to slightly increasing. And that's just the way log paper works. It takes into consideration compounding. The payments going through an 80% loan using conforming high balance loan limit interest rates, and same order as the previous slide. It just gives you some impact of interest rates on affordability. Here we're looking at the number of sales becoming a whole lot less interesting, that now you're sort of in the middle of the pack. We're the 6th worst year out of 10. We're the 21st worst year out of 25. So all the bad years are in the recent time frame, but in general, very long term, Silicon Valley has been selling fewer and fewer homes. And I believe that's because a fair number of people are locked into their existing homes because their capital gains tax and no longer Prop 13. Although even if you transfer your property tax, you now have to own or occupy it. So even leaving your house that you've owned under Prop 13 is a disadvantage. So I think there's a huge amount of inventory in the Bay Area that's locked in because our gains far exceed the $250,000 per person exclusion. Here's the raw numbers for Santa Clara, San Mateo, or Alameda County, as well as Silicon Valley overall. The different metrics are down the left-hand side. Here are some definitions for 3 distributions we'll get into, the first one being marketing time. This is a distribution for marketing time, and the time this is started at the 50th percentile, so half the sellers sell in less than 15 days right now, and going up to the 90th percentile. So we're basically looking at the distribution of the 50% of the sellers that don't sell immediately upon putting the house on the marketplace. Stepping through, we can see which direction it's going. You can see that you're moving up in time. That means that from this point in the year, you would expect longer and longer marketing times. That's the end of June, that's middle of July, end of July, beginning of August, beginning of middle, 2/3 through August, and beginning of September, end of September, coming down at the end of September, coming down at the beginning of October, coming down at the middle of October, now reversing it right at Halloween and getting slower again. So there's a slight improvement. Forgot what it was. Basically, the month of September and October, there was an improvement. Now you're getting the worst right there on January the 10th. And then you're improving rapidly. See how quickly this gets steep on the right-hand side. See how steep, and now watch. See how flat. You know it's slowing down, even though the lines are roughly at the same point. So with the flatter line, the market's already starting to deteriorate. The improving gets it steeper. You can see you climb. So basically from January 3rd on, you're increasing your marketing time more or less. And this is present time. So the purple is the current year. The dotted line is where we were a year ago, right on top of one another for all intents and purposes. A little faster through the middle part on the current year on the purple line. So the current year is outperforming last year by a little bit in the mid-range. Now we're doing the same thing with price reductions. And this is the sellers reducing their own asking price before the offer comes in. We're looking at a 15% segment of the marketplace downshifted by 2.5 percentile. So we're going from the 97.5 percentile down to the 82.5 percentile of the marketplace. And what are the price reductions? The dotted line is where we were last year. So we were taking more price reductions last year in 2025 than we are in the current year in 2026, which is the purple line. We'll start forward from last year and see how it progresses. Now it's the end of May. It's weekly data initially, but you can see that it's just really not going anywhere. Now it's starting to decrease, so getting worse. With larger and larger price adjustments. Right now, sort of at a plateau at the beginning of August, the end of August, beginning of September. End of September is an improving marketplace. The beginning of October improvement in the middle of October, and definitely worsening it right after Halloween. And now it's going to coast down for the end of the year. End of November, middle of December. December 27th was a slight improvement. January 10th is a huge improvement. The 24th, a huge improvement. Swinging up to February improvement. There's sort of the peak of the marketplace the week after Valentine's Day, because I'm doing every other week at this point. So probably Valentine's Day is the least amount of price reductions. You can see that you're taking more and more price reductions each week after Valentine's Day, getting up almost to present day, the 10th of May, the 17th of May, and now the 24th of May. And obviously with the 24th of May, that's because that's my normal calendar month calendar year that I talk about at the end of the seminar, but it's all the same data. So and there's very little change. So the data that I should actually be collecting tomorrow, but then I couldn't report on it until tomorrow. And I'd like to try to get these out as soon as I can after Saturday. Doing the same exact thing now again with overbidding. We're looking at the overbid distribution, the whole marketplace, basically starting down with the most overbidding, 5%, to the least amount of overbidding up here at 95%. 95% of the sellers are getting 5% reduction or better. Only 5% of the sellers are getting 35% over the ask price. And that's why it goes from 5 to 95 percentile. Same concept. The purple line is the current year, essentially right on top of last year. You could say that there's a little bit more aggressive overbidding this year in the purple line at the very high end, but only about 7.5% of the marketplace is doing better. The 92.5% of the market's doing the exact same as they did last year. Stepping through 1 week at a time initially, you can see that the line is moving down towards the blue line. So less and less overbidding is the direction you would expect it to happen. Now you're middle of July and you're still getting less overbidding. Beginning of August and less over. There's sort of the bottom, the end of August, August 23rd. See an improvement there in September, and overbidding is delayed. So the peak right there, the peak overbid November 1st, then actually November 15th, 35 days earlier than that would have been October. So right around October, September, or very early October is an improving marketplace, it looks like last year. And now you're approaching the bottom of the marketplace and you're already improving in February. Huge improvement around Valentine's Day. March is an improvement. That may be about the peak on the April the 5th is sort of the peak. Yep, definitely down on the 19th. down on the 26th. So now we're stepping down. So you basically would expect less and less overbidding between now and the middle of September. Here's the first thing, and this is turnover time. How long is it taking to sell? Notice every single region saw an improvement. This is a combination of two things. The normal reduction of new listings coming on the market because of the holiday weekend reduces your inventory, which means your turnover time is reduced. Also unusual, at least not expected, was a significant increase in the number of sales last week, which now accelerates the amount of number of offers that are getting accepted every week, which also reduces your turnover time. So the one that had the biggest reduction was probably up here at North Bay, followed by the cities, followed by Silicon Valley in the purple. Central Valley in the yellow and Central Coast in the blue had decreased, but not very significantly. Marketing time for 3 out of 4 sellers. I would say all 5 regions have increased still. So you're in time of increasing marketing times. Yes, Silicon Valley is technically flat, but I think that's going to turn around as soon as we start getting new inventory. Well, actually, next week it may go up because the homes that are selling this current week are going to have longer term. The week after, when you have an influx of new listings, there may be a decrease. So maybe there's really no net change on marketing time because it takes so long to season it. House price reductions, increasing number of magnitude or frequency of price reductions. So the overall average is increasing in all 5 regions. So across the board, you're having increasing price reductions. Frequency of price reductions, that's increasing all across the board. So more and more frequent price reductions, but keep in mind, it's from 11% to 26%. So it's still a small fraction of the marketplace that's taking price reductions. Here's the overbidding on average. Remember, there's the lag time for escrows, but basically going down or getting less overbid in all 5 regions, with maybe Central Valley being an exception because that's basically flat. But start off with the cities with the most overbidding at 117%, down to 116%. Silicon Valley was from 107.5% to 107%. North Bay is down less, about 1/4%. Central Valley is basically flat. Central Coast is probably down 0.5%. So across the board, overbidding is decreasing. Frequency of the overbidding decreasing in all regions. The region that's least down is the North Bay and the gray, but it's still down. So all 5 regions are decreasing frequency of price reductions. Offers accepted going up in all regions. Normally the number of offers peaks right around this week. This may be the peak or next week. Usually it's the Friday before Memorial Day, which would be yesterday. So this could be the record peak, and we may see an abrupt turn in decreasing number of offers starting next week. Number of active listings. This is a mixed bag. You clearly are going up in the Central Valley, clearly going up in the Central Valley. North Bay is pretty close to flat. Cities is down a little bit, and the Silicon Valley is down the most. Appreciation is all over the place. You've got the lowest amount of appreciation is roughly 68% of the original ask price from way back in the last 9 months of 2015. The area that has the highest is Silicon Valley at 200%. Just like in Santa Clara County, the expensive areas are making up a bigger percent. Keep in mind that Alameda County had less percent of normal transactions, and San Mateo and Alameda and Santa Clara County are both significantly more expensive. So that's pulling up the average for Silicon Valley, just like the average in Santa Clara County got pulled up by the more activity in Saratoga, Los Gatos, Los Altos, and Palo Alto. So anyway, the appreciations range from 200% to basically just shy of 170%. So about a 10-15% swing at the level of appreciation, but some of that is market mix. Median price is all over the place, but in general, it's going over. But notice it's sort of rolled over. I would even the cities has rolled over. Silicon Valley might actually be down. Central Coast is definitely down. North Bay was down but recovered this week, and so did the Central Valley, down and recovered. But more significant, in my opinion, is come back to the peak pricing. We're getting very close in Central Valley, close in the North Bay, close in Central Valley, Central Coast, very, very close in Silicon Valley, and close in the cities. So that's some of the closest we've been. If you look at the cities, it's at the highest number it's been since 2022. If you look at the Silicon Valley, it's right at the same level it was in 2025 and 2024, but basically right at that record high level. Central Coast is nowhere near the peak. North Bay is close to the peak, but they had a little blip back in 2024 that was higher here. And Central Valley has been basically floating around right near their previous peak, but they're only 550,000 for a median price, so quite a bit cheaper. Estimated payments using the high balance conforming loan limits, interest rates, and an 80% loan. You can get better interest rates than this by using relationship pricing and or doing a jumbo loan. Here's the raw numbers for the 5 regions and the 13 counties. I've also have Bay Area wide only because the media talks about it. You have the current reading under the now column, the change from the current reading a week ago, and the change in the reading from 5 weeks ago. So you can go and look at whatever metric you want across the top and the different regions or counties down this left-hand side. Here's my weekly sides. Really how I came up with this is we have a discontinuity with leap year on February 29th of every 4 years. And we also have a discontinuity in the fact that we have 1 extra day in a regular year, 2 extra days in a leap year. So I combined those and started off, said, let's start March 1st, jump forward every 7 days, all the way around to February 21st. And then I jump forward either 7 days on a leap year, 8 days on a non-leap year, 9 days on a leap year, and then I still go back 35. So these are the 5 weeks that vary based on leap year. Otherwise, you're comparing the same dates. You're comparing 35 days back from the day preceding the day I report. So this is the day I report. The data is through midnight the previous night. So for example, this week is the 24th. So I normally would report on the 24th, which means I'm using data through the 23rd at midnight. We're clearly not on the 23rd at midnight. So I'm comparing the data from May 23rd to data normally from May 24th. I hope that makes sense. This again is the control panel. We've been talking about Silicon Valley real estate and Greater Bay Area. I'm Richard Calhoun, real estate broker with Creekside, really working with buyers or sellers here in the Silicon Valley. If you want the handout, it's about 78 pages. Hit the QR code on the top left, type in the green root URL and then the purple edition on it. The MM and DD you substitute for the month 05 and the day 2323, or the long blue Google Drive storage link. If you want to listen live or comments or have questions, get into discussion, you can hit the QR code on the right-hand side in the center, type in the green root URL plus 2026, the year, or type in the long blue YouTube Zoom link. And finally, if you want to watch old episodes or this episode on YouTube, you hit the QR code on the lower left corner, the blue YouTube URL, or the very short root green URL. Thanks for joining. Take care. Bye for now.